Present. Here.
Daryl Pettis,
Here.
Clinton Rogers,
Here.
Kevin Wall,
Here.
Michael Wallstein,
Here.
and Thomas Wilson.
All right. Okay, looks like we have a healthy crowd. And I know a couple of you, we have to take off at different times. We got one person get out at 2:30, another person at least 3 o'clock. So if you are, I'm assuming if you leave the meeting that it's a scheduling issue. If you're leaving in anger, you're gonna have to say something because otherwise we won't know it. All right, so if you're walking out in a huff, state that. And so I'm also trying to do this off my phone. I can see a lot of things on my phone, but if I'm missing you and you're trying to speak, again, I think most of you have done this well. You just start talking and get my attention that way as well. We have some guests here today too, which is going to be great to talk about some good, fun stuff. So let's take a look first at the agenda. And so you'll see on here we have, we'll talk about audit thresholds, annuities, and some definitions, break in service. We're going to talk about combined service pensions and how those work. And we are actually working through our list at a pretty good clip, which is terrific. And so we expect everybody to get a bunch done today as well. So with that, if you'll take a look at the agenda, is there any discussion on the agenda? All right, seeing none, get yourself unmuted and ready to vote. All those in favor of the agenda before you, say aye.
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 Those opposed, say no. All right, ayes have it, and we'll go off of this agenda. Okay, taking a look at the minutes. So take a scan through those, see if you think we've captured what happened there, but nothing extra. Always, I appreciate, you'll notice that minutes are usually quite short under my tenure, and it's because as a parliamentarian, I learned real quick, you write down what you did. It's not always the best place to write why you did it, because it's pretty hard to capture that in a legal document. So those of you who take minutes, if you're a secretary and anyone gets on you for not writing enough, you're doing it right. You're doing it right. You're writing the results, emotions, and basic stuff like that. All right. Are there any changes to the minutes? All right. Hearing none, I think we're ready for a vote. All right. All those in favor of the minutes, as you see here, say aye.
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 Those opposed, say no. All right, we passed our minutes. Okay, all right, let's talk audit threshold changes. And so we are at a place now where we have some language to get specific about, and then talk about any final things. So we'll be able to kind of vote on this as a final shebang today. So I'll turn it over to, am I doing something? Okay, no, that's okay. It's you just get to see all what it takes to put on this show. There's a lot that goes on. Am I doing something? Oh, I thought I turned it off. Oh, I hear the thing in the background. Is it gone now? Yeah. All right. Nope. I thought I think I have my audio off, but if not, I can always. I don't. I think all right. Okay. So if you're hearing noise in the background, that's going to happen, I think. And so, Rose, if you want to talk through the language that y'all put together for us.
Okay, Exhibit B. So this is the work of what the group has been discussing since the first meeting in July. And the draft language provided in the attachment does three things. The first is that it increases the threshold that requires an annual audit, and the threshold would be increased up to $1 million in either special fund assets or special fund liabilities from the current $750,000. And that $1 million is for consistency with, or would provide some consistency with cities and some special districts. The draft language also allows relief associations that drop below the threshold to revert back to having an agreed upon procedures engagement done instead of a full financial audit. Right now in the statute, once you go over the threshold, you're locked in and are required to continue having an annual audit even if you drop below. So this would change it. So if you drop below the threshold, you can revert back to having the AUP performed. And then the third thing that we're doing with the draft is providing a 1-year grace period before the audit becomes required. And that has been a longstanding practice, and this just makes it clear that is provided. So once a relief association goes over the threshold, the audit would be required for the year after, for reports for the year after going over the threshold. But if a relief association drops below the threshold, the association could revert back to an AUP for the next reporting cycle. And then to note on the second page of the attachment, we have some effective date language there. And so we're trying to make it clear. We based this on language that the revisor's office had done in the working group bill 2 years ago when the threshold last was changed. And so that's what we based this effective date language on.
I can also mention that this summer we've been touring and meeting with auditors from private audit firms that do public audits. And so a number of them brought this up. So for anybody watching or anybody here, if your auditor said, hey, I'll see if I can bring that up to the auditor, they absolutely did. And they do deserve some credit for this idea too, because several of them were saying, hey, you know, this not being able to go back is not necessary. They didn't think that was necessary, and they thought this would be a help to their clientele on that. So I just to put in a word for a few of them, I should have their names all down now so they get credit for this. But if you're wondering, did my person do what they told me they would do? They did. Absolutely got the message out to us. Any either questions on the concept or the specific language or discussion, I should say. Okay, I think, boy, oh, Daryl, yes.
This is a great idea. Support this very strongly. Nicely done.
Oh, I totally agree. This is slick. And what's great is the work that the group is doing here will also help us in some of the work we're doing out of other divisions to look at audit thresholds for other entities. So I really appreciate, especially the effective date language. That is the biggest thing, is when does it start? So trying to make things as clear as possible. I really appreciate that. And so will a number of cities with populations under 2,500. I'm just going to say, we'll probably also appreciate quite a bit. Well, I think looks like we're ready for a vote. This would be the final vote on this language that will put this forward to the LCPR and share this with the legislators there for inclusion in, well, however they want to do it this year. So the language you see before us, so we're voting basically on Exhibit B. All those in favor of the language in Exhibit B, say aye.
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 Those opposed say no. Okay, the ayes have it, and we have something to give the revisers to do. They will love that. They're very happy that we're getting it done at the time we're getting it done. All right, let's move on now to the annuities discussion, where we also will have some special guests who will help us with this as well. So go ahead, Rose, if you'll walk us through.
Okay, Exhibit C. So there are about 18 fire relief associations right now that either pay or offer monthly service pensions. And almost all of those relief associations have discontinued the monthly benefit option for new firefighters. And so those groups still have monthly retirees they're paying out, but new firefighters who are hired just have a lump sum option. And as the number of monthly retirees receiving those benefits decreases, some relief associations have thought about or have pursued discontinuing the monthly benefit that's being paid out and replacing it either with a lump sum benefit or an annuity contract. And so the statute that authorizes that to happen is provided below the discussion at the bottom of page 1 and top of page 2. And so relief associations have expressed some questions, and we've heard from a few firefighters that had some concerns about a relief association's ability to replace monthly benefits with annuities. And so that's, we've got Scott, who with via actuarial, who had reached out and has some information on this topic that he can share. And then additionally, our OSA staff noted that some clarification to the statute would be helpful to just make it really clear in the list of authorized disbursements from the special fund that these annuities that are purchased to replace a monthly benefit are authorized disbursements. So on page 2, there's some underlined language there that would make it clear that these annuities would be authorized disbursements.
All right. So as you're taking a look at, and so did we want to throw for any comments from our special guest? I'll let you throw it over to him.
Sure. Scott, if you'd want to introduce yourself to the group and let us know, I think.
Basically what you saw me do is that I wondered if I had your bio or something and I was supposed to give you a great introduction. I did not have that. And so Scott, other than the fact that as a former math teacher, these are the people on our baseball type cards, you know, it would be actuaries. And so I'm always quite impressed with the actuarial people. It's quite a deal. So with that, Scott, if you wanted to add any context or things that you remember from the work you've done with this.
Absolutely. So my name is Scott Striegel. I'm an actuary with VIA Actuarial Solutions. I've been operating in the public space for about 5 years and had another 17 years in the private sector before that. So I have a lot of experience with these annuity placements on the private side. I've been working with that for about 12 years. And we recently worked through one with one of the fire relief associations here in the state. We attended some membership meetings. There were some misconceptions. So once we heard this was on the agenda, we reached out and wanted to offer some insight to make sure that, you know, a lot of people understood what these annuity transactions are, what the purpose is, and what safety nets are out there for people included in these. So I mean, first, you know, we want to be pragmatic and say that placing an annuity with an insurer probably is slightly less safe than being sponsored by a government entity. Just, you know, a permanent tax revenue stream is going to be the safest option. You know, the fire reliefs have a steady supply of income. It's backed by the cities and the state. So that is by far the safest option, but it also is not necessarily the best. The story that came from the relief we supported was that they just don't have the expertise to manage these annuities long term. You know, that every couple of years the board turns over. Many of these retirees, 80, 90 years old, they've moved out of state. They don't know how to track down annuitants. They don't know how to track down families. And that is something that insurers are most, you know, there's experts in this. They have software. They know how to connect the dots to find the deceased relatives, you know, next of kin and next of kin after the next of kin. That is just, they have the tools where each independent relief association just doesn't have the ability to do that. They don't have access to LexisNexis and People Finders, yada, yada, yada. So they felt it was time to kind of remove that administrative burden, and the annuity, well, taking a step back, you know, within the state rules, within government pensions, they could have just cut the annuity. They could have offered a buyout and said, we're just going to give everyone a, you know, $5,000 benefit, or, you know, something actuarially equivalent. That's not always fair. You have a 90-year-old annuitant. Am I betting on their life that they're going to live 2 or 3 years? Am I going to bet on their life they're going to live 10 years? You know, so how do you determine that? How do you make it fair? So they thought the most fair way to move forward was purchasing annuity, which would provide the exact same benefit they were already providing. Obviously, there are some concerns. What happens if the insurer that is selected goes belly up? And so that's what I'm here to talk about today, is what protections are out there for the insurers. So first and foremost, there are 16 to 20 insurers nationwide that participate in these type of transactions. In the small plan sector that would work with a fire relief association of the size that we see here in Minnesota, probably only 2 to 4. And even there, it narrows down a little bit because many of them don't like deferred lives. Many of them don't like odd provisions, such as a lump sum. So in the transaction we worked on, there were two insurers who came to the table, were very excited and wanting to help take on this transaction. They were United of Omaha and Midland National were the two insurers, both very highly rated, well-respected insurers. So some research was done to make sure that, yes, they are creditworthy, that they have the capital and everything needed to go forward with this transaction. The next thing to think about is what happens when an insurer actually becomes insolvent. You know, do all the people who have life insurance, annuities, policies with that insurer, do they lose out? And the answer is absolutely not. So within each state, there is a state guarantee association. And those state guarantee associations are similar to the FDIC that we all know from the banking world, that they will guarantee benefits with present values up to certain dollar amounts. So I believe the State Guarantee Association here in Minnesota would cover former fire relief members who live in Minnesota. Now, if someone moved out of state to North Dakota, they would be part of the North Dakota State Guarantee Association. But the State Guarantee Association will cover benefits in Minnesota up to $250,000. That would be the present value of benefits, not the sum of benefits over time. Each state has a different amount. $250,000 is the lowest. Some go to 3, some go to 350. Quick Google search could get that information. So that doesn't just mean the State Guarantee Association comes in and ponies up $250,000 per participant. What happens is all insurers licensed into the state are part of that State Guarantee Association. So let's say Securian, I don't want to badmouth Securian in any way, but let's say Securian was in there, they had a whole bunch of policies and they were declared insolvent. What would happen is if they have 99 cents in the dollar, their policies are funded at 99 cents in the dollar. So the participants lose 1% of the value of their policies. The State Guarantee Association then comes in and says, okay, well, anyone who's under that $250,000 threshold, we are making up that 1%. And if someone has a $500,000 benefit, well, they're going to, $500,000, they're going to lose that 1%. And the State Guarantee Association will not come in to bail out that person who has a policy worth $500,000. Any questions on that so far?
Could you maybe just say that last part again about what happens when there's a gap?
Oh.
I just want to hear it one more time.
Okay, so so I am a fire relief, so I have a policy, we'll say, with the insolvent insurer, and my policy is worth $250,000. Okay, once the insurer goes insolvent, they will look at the assets and say, well, they have enough to cover 99% of your policy. So the insurer assets will cover that 99%, and the State Guarantee Association will come in and top me up to make sure I get my full $250,000 value. One of you has a policy that is worth $251,000, right? So what would happen for you would be you would be funded at 99%, just like I was, but the State Guarantee Association will only top up the value for you back up to the 250 if needed. So you would take a $1,000 haircut in that situation. Similarly, if someone had a a policy much higher, they would lose 1% of their policy value if they're above the state limit.
That makes a lot more sense.
Okay.
It'd be tough to. It'd be pretty expensive to do it another way.
Yep, and then so who actually pays this? Who is the State Guarantee Association? That is actually all insurers licensed within the state. So any insurer who's doing business here, they bail out the other insurers. So there's a lot of self-policing going on. There's a lot of reporting requirements. Post 2008, they're not allowed to take the risks they used to. They're not investing 100% in private equity. They're not investing 100% equity. They're 97% bonds. They're 93% bonds if they're 125% funded, and then 7% equity. So these insurers, one of the things we do is we prepare a report that looks at how are they invested, how well funded are they, all of these things, and that goes into the calculus to determine is insurer A more safe than insurer B? Is insurer B more safe than insurer A? Basically, so we can help pick the safest provider, or help the fire relief pick the safest provider, to make sure that this is something that they can feel good about passing on to the participants, and making sure that now this insurer will be able to take care of them for life.
Thank you, that's helpful.
Just two other quick bits. So a 50-year-old with an annuity of $100 a month would have a value of about $600,000. Not many of these plans that offer monthly annuities are offering, and that'd be 30 years of service. So 30 years of service, $100 a month, 50 years old, that would be $600,000. By the time they get to 60, 70 years old, the value of that benefit drops quite quickly. So it wouldn't be too long before most participants are back under that $250,000 threshold.
I want to make sure, if you said, yeah, one more thing too, you wanted to pop in, right?
Me?
Yeah, I thought I heard a couple things at one point. I don't know if I miscounted. I just don't.
Oh, sorry. I said a couple points, but sorry, no, that was really the one. So the value of that 30-year retiree, it is quite great. I don't know how many fire reliefs have a pension close to $100 a month per year of service. Yeah, so if they're at $50 a month, right there, a 50-year-old, 30-year retiree, they're at the $300,000 mark, and it only goes down from there. So I think that's just a good data point to have in mind to really understand just how valuable that $250,000 protection really is.
I have a question just about when you said that there's basically just a couple of places that would do this work for our people. I think we all worry about we can start to get monopolies, or you start to get to the place where there's just not a lot of people doing it. Have you seen problems with just like fees and things like that because there's only just a couple? And we see this with audits when we're down. It used to be the big 8, now it's big 4, and sometimes it's big and you bid and you get one or none to bid. And so it's always a worry when you hear only a couple people do this work.
They are actually very, very eager for this business. What we find is that different insurers specialize in different spaces. So I named 2 insurers that really specialize in the small plan market. The Prudentials, the Mass Mutuals of the world, they want the giant transactions, the $500 million to $5 billion policies. Other ones say, no, we really like the sweet spot of these 10 to 100 people, this $5 million or less. That's kind of the space that we're in. And what they find is that this is a wonderful hedge for their life insurance business. If people live longer, life insurance is less valuable, but annuities cost more. If people die young, annuities, you gain money there, but you can take the win on the annuity side and pay out your life insurance. So they're kind of 2 opposite cash flows, and a lot of insurers like to have both of them in their portfolio because they hedge one another. As I said, there are a couple more in the space, but there's just a couple features with the Minnesota plans. Again, most plans, if you have the option for a monthly annuity, you also have the option for a lump sum. And the lump sums scare some away because that could be a big cash flow at an unplanned time. So if they had some confidence that everyone would take the lump sum at age 50, they could invest and hedge that. But if some people might take it at 50, some might take it at 55, some at 60, just because they can't track down a participant or that participant's not responsive, it happens, rare, but it happens. They can't hedge for that very well, and they don't like that uncertainty. So they just kind of walk away and say, lump sums, we just don't want to deal with those.
Interesting. Okay. More.
I just had a question about kind of in the unfortunate situation where the insurer does become insolvent. What kind of a time lag is there typically before? Like, I'm assuming if they're insolvent, then they go through bankruptcy proceedings.
I wish I could tell you that. There's usually about 1 to 3 insolvencies a year in the last 2 decades, and they're all small insurers. So that's something I'm not familiar. I know how the system works, at least from making participants whole, or making claim, people who have policies whole. But actually, the timeline, I don't know. generally, again, an insolvency doesn't mean that they don't have money. Generally means they have enough money to pay today. If they're 99% funded, 98% funded, suddenly their liabilities on their balance sheet exceed their assets, they will be declared either insolvent or put into rehabilitation. That means that they have money to pay everything now, they just don't have money to pay it far down the road. The other reason they would be declared insolvent would be they do have cash flow issues. I don't know what that would look like. That might have been an AIG thing where 2008, they were huge. They had all their money tied up into credit swaps, and the stock market fell out. The mortgage, credit swaps all fell apart, and they just didn't have any money to pay their policyholders. And in that case, the State Guarantee Association would start to pull money from the other insurers to continue making those payments as they started to take over the insurer. That's the way it's supposed to work. Again, in that one situation where one of these big ones was really in trouble, the government came in and said, nope, we're just giving you billions of dollars to keep this thing going. If we get down to the smaller, to these smaller insurers we're dealing with, I don't know exactly what that would look like. But I think the idea would be that money would start flowing in to keep the payments going, avoid as much disruption as possible, and then sort it out in the back end.
Thanks.
Michael?
Hi. About 27 years ago, I passed my Minnesota insurance license, so I might be able to help with that last question, but I had some questions as well. So my understanding with the State Guarantee Association is that they endeavor to make everybody whole that they can by 12 months, by the end of 12 months. That just is what sticks out with me. And there's other municipal guarantee associations out there as well, or municipal guarantee programs like Minnesota State School District Enhancement Program that offers similar guarantees. So I'm guessing that we're within a 12-month span, but who knows? The question I have for you is, so we went through a conversion. My Relief Association went through a conversion from defined benefit to defined contribution, and we did have some people that thankfully weren't on a monthly payout. I'm sorry, we did have a monthly payout, and when we tried rather unsuccessfully to find someone that would take over, do an annuity of some sort, we really ran into a brick wall. We found that the lump sum required to get them that monthly payment from the annuity company would be exorbitant. And so fortunately, we were able to work with the participants, and they all chose lump sum. Or said another way, we didn't really speak all that much about the monthly option either. So there's that. But interest rates were lower then. I understand the crediting ratios are different, but so can you speak to me about how affordable was it for this Fire Relief Association to get there to take that lump sum and buy that monthly annuity contract for them?
That is actually a great question. Right now is a very opportunistic time due to the high interest rates we're in. I would say 2-3 years ago, actually probably 3 to 5 years ago, these policies would have been 10 to 25% more expensive due to the lowest interest rate environment we were coming out of. Right now, interest rates are about 5.5%, which would bring the liabilities down to less than what these fire relief associations are holding as a funding liability in their actuarial evaluation reports. The state mandates we use a 5% interest rate assumption, so the relief we supported actually paid a premium lower than the liability that was on their books.
Lovely. And then my follow-up question is that you mentioned that these companies they're excited about the risk. They like that kind of risk with the hundreds or thousands of participants and the big lump sum cash dollars as a diversifier. Maybe I'm reading this wrong, but it seems as if we're looking at a couple of fire relief associations with 10 to 30 participants that maybe have, a couple $100,000 to put to this. Do they have an appetite for that as well?
I think they do. If fire relief associations wanted to come together, that might get them some better buying power, get them a little more attention in the space. We would have to be very clear about the provisions for each participant. So for the most part, what they care about and what they care about is easy to administer provisions. So the Relief Association, sorry, I'm fumbling my words. The Relief Association we worked with had a couple provisions in there that had annuitant death benefits very similar to their lump sum death benefits, where it said, well, if the annuitant dies, and they also had a joint survivor that paid 50% to the spouse automatic, and if the spouse died, it popped back up to 100%. But then if the participant died and the spouse died, then it would pay the annuity to the child till the child turned 18. And it could, if they had 3 children, it could pay 300% of the benefit going to all 3 children. An insured is just fine with a pop-up benefit. They're just fine with a continuation to a spouse. That is just absolutely normal. But paying to a child till the age of 18 starts to get a little bit goofy, you know, because there's no way that they can actually know who these children are. They're a little bit harder to find. Yeah. So the Relief Association looked at their membership, said, oh, here's our group of annuitants. This actually doesn't apply. Or if it does apply, it might apply to one participant if they have a child in the next couple of years before they retire at age 50. You know, so they ended up stripping that child benefit out of the plan. They got together with membership, voted it out, and then took that provision, that set of provisions to the insurers, who were then happy to bid on it. But with a provision like that, so you just need to look at the different relief associations, scan the provisions, say, is this something insurers would be interested in? If yes, then really we just need to know benefit amounts. We need to know census information, who's getting these benefits, birth dates, and things like that. And yeah, and then the insurers can sort it out from there.
Really appreciate it.
Oh, happy to help.
Yeah, Daryl.
So the 18 associations that offer this, are they generally larger associations, mid-size, smaller, or are they all over the board? If I may ask.
For the most part, they are larger relief associations in the metro area. I think there's one smaller one in Greater Minnesota, but larger metro kind of suburban departments.
Okay. There's lots of different annuities out there. There's immediate, there's deferred, there's variable, there's fixed. Does the retiree have any say on, is just you get a single premium annuity when you become eligible at 50 and we pay you out until you pass away, or is there options for the annuitant, is how they invest their annuity before they turn their income stream on, or are we opening a whole can of worms with that, or not? That's all I have.
So these group annuities are essentially single premium annuities that are meant to perfectly replicate the provisions of the plan as it stands today. So the only optionality would be if you, so for a retiree, if you're paying them $1,200 a month, it will just continue that $1,200 a month. And if they have a spouse election on file, then it will pay their spouse after they pass away. So retirees have no options at all. It would just completely replicate exactly what they should be getting from the relief. It's just now the check is being written from an insurance company instead. For a deferred, the optionality would be if they have the choice between an annuity and a lump sum when it comes time to commence, then they can either choose their lump sum based off of the benefit level that the Relief Association has in place for their lump sum, or the annuity based off the amount that the Relief Association has in place for the annuity. So there's one choice, and once they make that election at age 50, then it's locked in and they'll get that benefit for the rest of their lives, or can take their one-time payout and then they're off the books.
I have a question. Do you anticipate this becoming a more popular option or less popular option going forward? Do you expect that when people see this, it'll kind of help them say, hey, you know, this might be something we want? If you were going to guess, what do you guess?
More popular. So coming from the private sector, this has been all the rage since Ford Motor Company came out, we'll say 12 to 15 years ago, with a massive billions of dollar one where they went out and just bought annuities for their retirees and said, Ford Motor Company, we are a pension company that makes cars, and we don't want to do that anymore. We our pension fund is greater than our market cap, so we're going to get rid of these things. And most private plan sponsors, and the public usually follows the private plan space. It's just a matter of time. Most private plan sponsors, they've been freezing plans. They want to get rid of their pensions. They want to move to defined contribution. And this is the way to make it happen. It's something that they can do piecemeal. So they don't have to have a fully funded plan. They can lift out some retirees and take out a section of the plan now. And then when they get a little more funding, they can take out another section. And we're starting to see some interest in the public plan space as well. And that's just the case. So as soon as the Relief Association we helped did this, they no longer have to have a full actuarial funding valuation. They only have to do their GASB 67, 68 valuations. It changes their audit requirements a little bit. So it simplifies a lot of things in their end. And as I said, now they don't have to administer monthly payments to annuitants that, they may not know anymore. There's some, well, I think when this first started, some of them, they knew all the retirees. They knew where to go knock if they needed to trace down a guy. Now, someone moves to Arizona and he's 85 years old, and it's a 40-year-old treasurer who's responsible for keeping track of him. And he's just, once the relationships start to fall apart, he says, this is a lot harder for me in my free time as a volunteer to administer this. And I'm not even an expert in it in the first place. He just said it just made sense. Lump sums we can do. But beyond that, it's too much.
So it's going to take, so basically people take a hit on this are actuaries. Is that you're just going to have, those are the people that are going to, I guess you won't have enough business to keep busy.
Exactly. And the joke is, when I entered the profession in 2003, they said, why would you enter Royal Pensions? They're going to be gone. And, the guy, my mentor, who was another 30 years older than me, said when he entered the profession in 1970 something, people said, well, why would you get into pensions? They're a dying breed. So yeah, we're trying to right size ourselves as we go, but ultimately with time, we do expect the profession to, the field of potential clients to continue to shrink. But we're consultants. We're here to help them find solutions that work for them, and that's what's one of the most helpful solutions at the moment, is helping clients get rid of pensions.
Sure. All right. Other comments or questions? Also, this would be a good time to also talk about whether you would support this. I feel like, I don't know if I've heard anything that would suggest that there's a problem with this. Is there anything I'm missing? Anybody? And that's Scott too, but let's start with Michael. Anything that could be challenging about this? Michael, yeah, what are you thinking?
Well, so, I don't claim to know everything, but I certainly kicked a lot of rocks to try to find some solutions. So how can fire relief associations best work with our actuarials to come up with this solution? This seems like it's amazing that you have the resources. That's fantastic. If you didn't have those names, I don't know how you would have, how as a fire relief officer at any other municipality, that I would be able to conduct a due diligence search to come up with a candidate list for the right names.
Oh, you're talking about the right names of who to even get a bid from, kind of a thing.
The insurance companies, that's right. I wouldn't know, almost 30 years in this finance business, I wouldn't know where to start.
Yeah, so there are companies that help. That is something we do, and I don't mean to be here selling that service today, but just the fact that we did help another relief association. So we run a reverse auction process where we send out some basic stats to the insurers that are in the space and ask for preliminary quotes, see what the pricing is. We vet them, and then from there go back to the relief association, and then they bid again. We say, here's the lowest price. Insurers, do you want to beat that? And then they'll come in with a better price. So it's a process to make sure we get, first we vet them, make sure that they're all equally good, and we want them bidding. And once they determine that, yes, they're equally good, then it's a competition for the lowest price. Who wants the business the most? So it's called pension risk transfer. There are a lot of firms that are in the space, something we're very happy to help with, but there's others out there too. As far as actually just finding a list, and that was something, one of my clients, I think they have 3 retirees. I said, I could give you names, you probably don't want to pay a consultant to come in and help, for 3 retirees, go through that process and run the reverse auction.
Sure.
So that would be something, if you talk to your actuary who's working with you, they probably have some ideas that can make some recommendations.
Daryl?
Definitely support this. We did this 15, 20 years ago. We had one or two retirees that were earning a monthly pension, and just got a lot of work off of our back and books. And it was a good move at that time, and I would support doing this if these departments want to do it. It's well worth the time and effort. I would support it.
From what if I'm reading it, the way I'm reading it is, though it is a bit more risky than, of course, just a steady stream right from a government entity. But I think what you pick up in risk there, you definitely lose in the risk of error, missing dates, all the problems that we have with turnover and staffing issues that I think we're seeing all across the country and anything financial and public right now. So it seems like it's a balance. It's a pretty reasonable balance and I think you may probably come out ahead in the risk calculation when you're done with this, I would say. So any other further discussion? I think we might, and also anything on the specific language too. Like I said, it sounds like we might be ready to move forward to vote. Anything? Well, all right, I think we're there. So with that, we are voting on adding the language which makes these options clear into statute. And again, it's the stuff that is basically adding the underlined stuff in Exhibit C. All those in favor say aye.
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 All those opposed say no. All right, the ayes have it, and we've got another option that's a little more clear for people. So thank you, and also thank you, Scott. This was really impressive. You are, of course, welcome to stay and hang out.
I think I will, and I just want to say thank you for letting me come speak today. I appreciate your time.
This was super helpful. Really do appreciate it. Well, with that, let's move to our next topic, definitions. All right, and so let's talk about break in service to make sure we are that we've got everything nice and tight in that. So Rose, do you want to talk through the issues surrounding that?
Okay, Exhibit D. So this topic was suggested during the July working group meeting as something to add to the topic list, and it got ranked pretty high. And so the suggestion was to review and discuss the definition of break-in service. So the definition is provided here below in the handout. And I guess the questions that we have are, does this still seem reasonable? Does it seem accurate? Are there scenarios that aren't being covered by this or suggested changes that the group have? And I think the thought too was that the discussion would be a little bit broader about breaks in service and how relief associations are handling those, if I'm remembering the conversation.
Yeah, so we go right to discussion. We talk about break in service. So let's just take these questions, answering any of these questions. Is this definition still working, or do we need to gussy it up? Anyone want to speak to that to start? Yes, go right. Yeah, go ahead. Yes.
This is a hot topic for us in our department. At least what we've seen is we're seeing a lot more breaks in service of just, we track call percentage on a quarterly basis. And so at least the way our bylaws are set up, it doesn't, do those quarterly percentages break, are those classified as break-in services as per the bylaws and such? And so we've moved and put language in our SOPs, SOGs that include a good standing measure, which helps the department itself, but it doesn't help the relief. And so, like, we were looking at language that says break-in service is, any of these pieces of breaks, but also then failing to meet the in good standing provision that's set up by the department.
And so is that, have you had any problems with that language
Well,
not serving you or anything like that? Or what do
I mean, we're not there yet. I mean, it's still kind of up in the air. But you know, the trickiest parts that when we get to break in service and tied to return to service is the provisions where it happens where we have people that are in break in service, but then it's shorter than a year of break in service and may revolve around not making quarterly percentage, but then getting a increase in bump on the lump sum benefit amount, but not being in service during, you know, or having a majority of that in break in service, but not a formal break in service where they've, you know, it just, we run into this quagmire where it takes care of itself with regards to the vesting percentages, but it doesn't take care of itself with regards to what benefit you pay out on when they actually pull the trigger or when they actually come back, returning to service for a specific amount of time, things like that. And we're seeing a lot of that now, just because at least with our department, you know, we're a younger department. People are more active in families. People are taking bigger breaks. We've got 8, 9 full-time department members. So not only are they volunteer firefighters, but they've moved on to be career firefighters. So how that ties into them making training sessions. And I mean, there's a lot of things that are evolving for us.
We have a question that came up in the chat here, and just a reminder on how we use the chat. And I appreciate, I know he's going back in and necessarily answering in the chat. We want everything to be out on the meeting, on the screen, on the video and all of that. So we don't have to keep too many extra records. And so the question was, what about EMS only? What do you think about that?
Yeah, so there is authority for a fire relief association to amend its bylaws to allow individuals who solely perform medical services, volunteer emergency medical services, to be members of the Relief Association and then to qualify for benefits on the same basis as individuals doing firefighting. In order to do that, the Relief Association has to amend its bylaws to allow for it, and the municipality also has to approve it, since it's a expansion of the membership, so it would increase liabilities. So we do track how many relief associations, at least on the reports that they file with us, show that they have EMS only who are members of the relief, and they're not that many. And so in terms of breaks in service, it does get tricky, because breaks in service, like active service and what it means to be active and to be in good standing, is something that's defined in usually the fire department policies, which would be, you know, city or town policies, but they interact with pension credit that the individual is eligible for in the Relief Association. So it really does sometimes get a little bit tricky to kind of have to monitor both of those and see how they interact together.
And again, it came up, I didn't get a name attached to that question, so just wanted to see if that answered the question. The person can either say it verbally, just kind of pop in and say yes or no, or feel free to type it in the chat as well.
Madam Auditor,
Oh, yeah.
what I was referring to is in the definition period portion of it, it says all of the following with a particular fire department, and then they list 4 qualifications, either performing or supervising, but they're all related to fire suppression. So if you have a member that's EMS only and they're in the Relief Association, how do you make sure that they're covered equally with the same policy that affects the firefighters?
They got to, every time they do something, instead of just a tiny fire, and just have them stamp it out, and then we comment. And so, sorry about that. But I could see Rose looking things up and writing furiously. Thoughts on that off the top of your head?
I think that's a very good question.
We
We'll have to look at it. Yeah.
Boy, good point.
Madam Auditor.
Yeah,
But
yeah. Michael.
one more piece. I think like break in service solves a lot of problems on an annual basis because service credits are distributed by the chief, and once those are distributed, there's the opportunity to dispute it or whatever. But then it really just becomes that becomes fact. For us, it's the trickiness comes in when it's in the year of when those retirements happen in the year of, and those service credits aren't going to be posted, right? And there's break in service with regards to call percentages.
Yeah, I don't, Daryl, what's your experience with this? Thoughts?
We changed our bylaws a number of years ago. We used to do semi-annually or twice a year to once a year. So you either get credit for the entire year or you don't get credit for the entire year. So the break in service, it's always kind of an issue. Leaves of absence, you take months off for leaves of absence, suspensions and things like that. But it is a very difficult thing to fairly address.
So do you have would you have to have like a percentage in there, the amount of the year and prorated, or what do you do now? Anybody who wants to say that, I have no idea.
Yeah, well, and that's where it gets tricky. So fire departments have the ability to define locally how they're going to monitor compliance with whatever the active service requirements are that are defined. Relief associations have the ability to award for pension purposes service credit either for completed months of service or for completed years of service. So those are the two options. And then if the relief association chooses to do service credit for months of service, the bylaws could define a month, and it has to have at least 16 days. But the options would be months or years.
So if you went by months, if you're worried about, you want some granularity there and you want to be able to take into account the different things, one of the solutions might be going from years to months.
Mm-hmm.
And if you really don't want to deal with that granularity, then going the other way makes a lot of sense as well.
Mm-hmm.
Yes, Daryl.
Months create a whole other issue for volunteer departments if you don't have any fare calls that month. So all of you are deficient for that month then.
That's a good point.
So months create a whole bunch of problems.
You'd be sad that there weren't any fires. Yeah. Carl.
I'll echo what some of the other people said. Probably about 5 years ago, our department switched from quarters to annual. It caused some strife for people just because of what happens if you could miss an entire year now if you don't meet your quota expectations and stuff like that instead of just a quarter. But to talk about directly with the break in service, we had a kind of a head scratching situation that we were dealing with, a member who was gone for a while, and then some back and forth with the city, and these 4 definitions were really helpful for us to kind of define, where were they with us or were they not, during that time that they're away from the department and the relief association. So I felt like these were pretty clear to us that they were, whether they were participating in fire suppression and supervision duties or not. So.
Do you think, Carl, did you think they were at the right place? They want clarity, but you think they were a good idea, or they were the ones that made sense too, as well as them be clear?
I think these made sense to us and they were clear. Yeah. I think there was some questions of okay, well, is it an approved leave of absence versus a break in service versus there was some head scratching moments around that. What's the difference between if they're, leaving, is there a difference between if they're leaving the department for, a year or 2 years or 3 years versus, oh, I'm just going to take a medical leave for 6 months? Is there a difference there or not? And so there's still some nuance there, but I think we had enough to kind of work with it.
Thank you. Dan.
Yeah, I think Carl was hitting it the nail right on the head there. To me, the definition of what a break in service is clear enough. The cloudiness, the questions come in, and how does a relief association interpret that in terms of how they're crediting, and depending on how long a person is out for, and when they come back, how they execute all that. But I think looking at that makes it pretty clear. I mean, they're doing those things or they're not. And whether you do it monthly, quarterly, or yearly, the definition is still the same.
So it sounds like if we have a deficit in the definition, it might be like we're saying EMS only. And should we maybe look at, see if there's something we could write for next time for that? Get some sample maybe?
Yeah, yep, we can review it, and if it is determined that we need something, we could draft it up.
Okay, so I think that's one thing that we may want to take a look and see if there's an issue with that. We could maybe, yeah, so is there any other things that you think, any other places we need to solve the definition, or we just need to make it so, because the other issue I think that is a little thornier, the idea of how much and what percentage and all of those things. I'm wondering if that's something that we should put in statute at all, or if we want to keep it really open and just help people write it in a way that write their own stuff, the way of how they apply it. Yeah, Michael, what are you thinking?
Is it common practice for departments to have, like for us, the way I see us solving our problem is to leave the break in service language the way it is, but add in that break in service, a member has failed to meet our fire department's good standing requirement. And that kind of bundles it all up for us, but I don't know if every department has that type of language, right? And so is that something that we can go off chart and do on our own, or?
Oh, now we've got people scrolling through statute on their phones too. So it's getting big now. It's serious. If you guys can do this off the top of your head, I'd be really impressed. I could cover for you. Tell some jokes. No, you guys. what do y'all think? Oh, do we think that? Let's see if I can guess. I'll have you restate it.
Well, I'm curious to see, are other fire departments, do they have SOPs that are in place that have a quote unquote good standing requirement, like as part of their, I'm assuming it's part of their employment with contract with the department or with the firefighter. They've got some type of criteria. Do they have those criterias labeled in their bylaws as part of break in service? You've got to meet these requirements of performing suppression duties, so on and so on, but also need to meet the requirements, basic requirements as required by the fire department.
Is it common enough
Yeah.
that it would make sense? An SOP, just to make sure I understand this, and we'll say this is for people who are watching, standard operating procedure, right?
Yep.
Is that what we're talking
Yep.
about? Okay, thanks.
Yeah, and I think many relief association bylaws do refer to the minimum service requirements defined by the fire department or municipality. And I think our sample bylaws that we have, which we're in the process of updating, also include that in as an option. Is active service means, and it's complying with those requirements that are set by the department.
Does it need to be in here that it says, or things that are in their bylaws or anything like that? Or has that been an issue? I don't always want to add something if everyone kind of understands that. But would anybody say, oh, it's not in this list, but it's in our bylaws, I bet we can't do them? If something was here, would people worry about that? Or assume they couldn't do it because it's not listed here?
Madam Auditor?
Yeah, oh, I'm sorry, yes, hop in.
I'm a little bit confused because we're talking about a standard for the membership in the Relief Association.
Oh.
But yet the member in good standing comes from the administration.
So the question that I have is, you already have to be a member, so that's already the first screen, right? You got to screen it first. It's whether you're a member or not, then we talk about this stuff. So if you're not a member in good standings, none of this stuff applies anyway. Maybe I might not be restating what you said at all, but maybe Daryl, yeah. I'm sorry, go ahead.
Every year, the chief has to certify
Yeah.
through the Relief Association who gets what credit for the previous year, based on a member in good standing ruling, whatever the administration decides.
Right, so that's already at
So
another place.
that's,
Okay.
that's in the law. But now are we adding to that by saying the Relief Association can add on to that?
Fair, I think yes, my idea, I think, sounds like it would make it worse, or make it, would not be able, yeah, Daryl.
We specifically do not define good standing or what is required to receive a year of service within our bylaws. That's something that has to be handled by the municipality, and we specifically stay out of that. That's the way we handle it.
So adding it here might make it, okay, yeah, Michael.
Do your bylaws refer back to it, or are they part of, is that just covered as part of active service?
Anyone want to hop in? You guys just go back and forth, yeah.
Our bylaws here do not specify that the relief has anything to do with it. In the bylaws, we state that member in good standing comes from the administration to follow the law.
Yep.
So I mean, if somebody
Same
comes
here.
to us and says, and they have a question about it, saying, I didn't get credit for a full year, we have to send them to the chief because he's the one that decides it.
So.
Yeah, I agree with that statement. I
So it
mean,
sounds like if things are in both places, it might be just kind of restating what.
restating the obvious.
Yeah, well, and maybe, and there's always a challenge that if something changes with how people define that, then you got to go back and change your bylaws. So maybe it's something that should be in your bylaws in the first place, and you may not want to restate what another, or just say that this comes from there. Might be safer, or take a little less effort. Though I got to say, having an addendum that has that available right in the bylaws is a benefit. You know, I think just for the ease of reading, having all that information in one place. So having it just as a reference instead of actually part of the bylaws might be a way to do it.
I don't see it as being us spelling out what good standing is.
Okay.
I think I see it as break in service being reiterated, that a break in service is a cease of fire suppression and duties and so on. And also, if a member's not in good standing, I think it is as stipulated by the fire department. But I can see even in section 5 where it's active service, it's got it listed that active service is, meeting the minimum service requirements as specified by the fire department. So you end up double dipping just in 2 spots. So, I mean, I feel like answer kind of self-served is that if you're not in break-in service, then you're in active service, right? So, or if you're not in active service, you're in break-in service.
So there's a difference, and it gives you a space to have 2 ways to say it.
Yeah.
That a break in service is different than not being in good standing.
Yeah.
Okay. It sounds like we're.
As an example, Madam Auditor,
Yes.
a couple of years ago, we had a firefighter that was on for 6-7 years, and he moved out of state. After a couple of years, his family wanted to move back up here, and he did. And he came to us and said, I'd like to rejoin. And sent him to the chief and said, fill out an application, goes through the district. And when they rehired him, okay, he kept his seniority in the Relief Association, because once you acquire that, it's never taken away from you. Follow?
Yes.
But
Yeah.
as far as the fire department, he's a rehire, and he starts out with 1 year, but with us, he started out as far as going up the ladder at 7 or 8, wherever he left off.
Sure. I could see why you'd
So
want
it wasn't up to the relief to hire him back. It was up to the fire protection district, who does all the hiring. I mean, they have the final say on it, so,
Got it.
you know, we weren't involved.
I think, yeah, that makes sense. So yeah, I think I think we have that kind of that there's a,
I mean, it,
if I'm following, it sounds like these definitions don't necessarily need to change. As long as we understand that that's just covered in just a kind of a, I'm like, first level, are you even a member? And then after that, we can talk. Okay, fair. Okay. Did you, Rose, do you think you got what you needed to decide what, yeah?
Yeah, I think that we are good. And then before the next meeting, we will review internally whether any, we might have any suggestions in terms of EMS only for the definition.
Got it. All right, any objection to proceeding with them just checking on EMS only at this point? By the way, thank you all for training me in on that. You know how you think you understand something until you really understand it. So thank you, I appreciate that. All right, well, let's go to our last order of business on here. Combined service pensions. Let's go to Exhibit E, and we're going to talk about whether we want to talk about concurrence. In a way, this follows the last thing kind of nicely. So, Rose, if you want to walk through the issues involved in combined service.
Okay, this topic was brought to or suggested for the group to consider by a few relief associations. And the topic is what to do if there are a firefighter is serving on 2 fire departments at the same time, and whether if that person is receiving service credit in both relief associations at the same time, how does that or does it fit in with the combined service pension provision? A few years ago, the working group looked at and updated the combined service pension statute here, and there is language that refers to subsequent relief association, and then also requires that a member become a member of the subsequent relief association within 2 years of the date of termination of active service with a prior relief association. So that it implies that service is subsequent, like if someone's with one fire department, they serve there, they're done, and then they go someplace else and serve on that fire department, and then they're done. It doesn't really anticipate that somebody's serving on 2 departments at the same time and using this provision. So I think that the questions that were brought to the group is, do you want to clarify this statute to either like clearly allow it or to make it clear that it's not permitted, or to address it. We're not aware of many at all relief associations that provide for combined service pensions. It has, in order to offer them, the language has to be provided in the bylaws of all participating reliefs. And right now, we don't see combined service pension language in bylaws at all, hardly at all. There's only a very small handful that have taken advantage of this. So that might be kind of a separate question, is it something like, are there obstacles to doing this right now that the group would want to look at addressing?
Right, can you give me an example of what could happen where, let's say I'm in 2, right? I'm in the city of Ramsey and city now then, because that's where I live. That might be the 2 I would do. So I say I'm in Ramsey now then, and again, I don't know their bylaws, so do not take this advice, Ramsey or now then.
Yeah, so if you were in both, you could be eligible for accruing relief service credit in both relief associations, as long as you're meeting the requirements of both departments separately. Everything's being kept track of separately. If you become vested in both Ramsey and in Now Then, based solely on your service with that specific department, then you could qualify for a service pension distribution from both relief associations. What the combined service pension provision allows for is if somebody is on one department and then moves, but then continues on as a firefighter in another department, it allows you to combine service pension for vesting purposes in both departments. So So it's a way to kind of incentivize people to stay in the fire service. And it is for the second department, if they choose to hire that person on, they're hiring somebody who has experience. And so it's, yeah,
But it's not gonna happen unless
unless
it is in your bylaws.
it's in your bylaws.
Got it.
Yep. And the reason that it has to be in the bylaws is because the second department, that relief association, will be paying out more because it's based on the combined service for vesting purposes. So they would be paying out more than what they would have if it was just based on length of service in that department.
Right, so people's thoughts on this, is this something that want to be real clear about, that that you can do this? Want to clear that you can't do this, or leave it kind of where it is right now, where it's basically it's available, it's just not necessarily may not be as clear to as many people. Yeah, Michael.
Well, so what I took from all of that is that it is available. It's just complicated. So are we advocating for clarification? That's it? It seems as if we wouldn't make any changes. We would just reiterate that it's available. Is that what I'm to gather?
Yeah.
So it is complicated. I don't know that it's really
I think our thought based on the current language is that it wouldn't be permitted today for concurrent service. It would only be allowed for successive service. So if you move from one department to another, it would be permitted, but not if you're serving in two departments. That's kind of been our assumption. So, you know, I don't know that we've come up against any situation where someone has argued otherwise. It's just, so I don't know how.
So maybe the question is, okay, so maybe an example of something you think is not permitted would be, this is a guess here. So I'm in Ramsey and 5 years in Ramsey and if you want to call it Burns Township, because that's what it was when I grew up. But then I go to St. Michael. I can't. Is the trick I want to try to claim 10 years now? Is that what? Okay, I just want give me an example of what isn't an option, maybe. Rose and Michael.
Yeah, so what isn't an option right now is if you are on both the Ramsey and Now Then fire departments, which I think they have a combined department now, but let's say you're on Ramsey and Now Then fire department. They split?
Yeah,
They
that's,
split. Oh, that's right, they split.
You live out there.
Okay, so you're on both departments at the same time.
Yeah.
And you serve for, let's say, 3 years on both departments. You don't have enough service credit to be vested. In
Oh, I
either
can't combine that and say, okay, I'm ditching Ramsey.
Right, yeah.
I'm staying here and Now Then, but now you gotta count me at 6.
Yep.
Okay, yeah, is that,
That's right.
and we, yeah, okay, now we got people. Okay, so let's go Daryl, then Carl.
We've known about this for a while. This has been allowed for a while, but we've never really discussed it as a relief association. We have a couple of members that it may have benefited, but it just didn't seem to be a real benefit to the rest of the membership, so it just kind of never went anywhere. So we don't currently have this in our bylaws right now, and I don't foresee us adding it anytime soon.
Okay, Carl, and then Michael, did you want to go after that?
Sure.
I think some of Rose's points resonated with me again. Yeah, I've known about this for a while, but the complexity of having to have, you know, both parties, both relief associations kind of have this provision, and then, you know, when one relief association might have a much higher or smaller benefit level, and the complexities there. And you mentioned how it could be a recruitment tool, yet the relief association is not the hiring body. So like that's kind of that's complicated. Just a mental thought pattern of it. It doesn't really resonate with me that you would, you know, be able to serve, you know, 5 years on 2 departments at once and then suddenly have 10 years of credit. That doesn't really resonate with me at the moment. It does resonate with me that if you serve 5 years in one place and 5 years in another place, that somehow that could work, but it almost need to have like a third party state backer to kind of help bridge that gap in my brain. Does the para plan allow that? As a question. So if they're on two departments that are both para, does that allow that?
I don't know.
That's a good question. I don't think that you would, I think that, again, you're talking about time, right? And so, we talked about you can't be doing two things at once, right? And so you can only be in one place at one time. So I think, and okay, now this might be wrong, but para, it's more like, how many hours are you doing this work? And it's less going to be about, I don't know. I'm not going to pretend I didn't say any of that. And so just erase that. I think that'd be something that we should check on. I am interested as well. I'm trying to think, maybe I'm also thinking as a teacher, if I was teaching in two different school districts, it would just be the hours be just kind of coming together because but again,
it's one plan.
It's one plan though.
For what it's worth, I'm thinking this.
Yeah, okay, so if it's one plan, it's like I am a teacher. And so it's based on what I made in each place, right? Because we had a high five or whatever. And so it's based on each place. And so I'm going out doing teachery stuff at different rates, but it's not what school district it is in is less important than the rates of what I'm doing, being paid at each district. We're gonna still check.
But to add to that, for the concurrent thing, if there was two fire reliefs that were in the para plan, and they did 5 years in one para plan and then moved to a different department that happened to be on the para plan as well, would they get 10? That would be automatically that they would get 10 years then? That'd be an automatic thing for the para if they're both departments were in para?
We'll have to check. I think para did put together some like informational handouts on this type of service in the SBF plan. And so we could take a look at that.
Yeah, I know there's something that is there, just not sure what it is. Now I'm looking at some hands went down, so I think I have Alina next.
Yeah, I was just going to comment on that question about the para plan. This is Alina Wilson from the LCPR. So usually what most of the public pension plans do is if you're in a different pension plan, so say you're in MSRS and then you go to work at another job, then you're now covered in para, your contributions and service remain sort of in the plan where it was earned. There can be provisions to kind of transfer service, but the default is that it remains where it's earned, if that's helpful information for everyone.
So like if I taught in two school districts and skip back and forth, that's one thing if I'm half time in two school districts versus say I was a teacher and then come elected state auditor. So I've got MSRS and TRA and that's separate. They don't necessarily cross over each other in that way.
That's right.
Yeah,
yep.
Thanks. I see Michael.
I wouldn't be in favor of using this for my fire relief association, but I come at this with the permissive spirit. We don't necessarily wrestle with the same issues that some other departments wrestle with. The recruitment and retention crisis that we have in the fire service is real. And if a fire relief association feels strongly enough that they want to allocate pension dollars in that way, it's their money. They're allocating their pension. If it's between closing up shop and going this way, I would want to give them the ability to do so. I think it should be a last resort. Maybe we come at this with a minimum vesting period. Maybe it's a minimum vesting of say 7 years rather than 5. Or something like that to make sure that at least this provision is used wisely for recruitment and retention. But again, just coming at it from a permissive standpoint, if it's something that reliefs are asking for, we may want to consider it.
Yeah, maybe that's the question. Is anybody actually asking for this, or we're just trying to get ahead of what could be an issue?
Yeah, we've had a few, and a few is maybe 2 relief associations ask about this.
I think so they could do it, or just want to know if they could do it now, and we're actually perfectly happy to find out they couldn't.
I think ask the working group to take this up as a topic. So they had firefighters who are on another department at the same time, and I think they just didn't know what options were available to
But they weren't asking necessarily for more options.
I'm not sure.
The only thing I'm saying, I kind of talk about complexity, you know, adding, if we add just in case language and nobody is actually pursuing it versus just checking on it. I think that sometimes doing everything is problematic, and that adding extra complexity, if nobody wants it, can just get overwhelming and just lead to more errors. So maybe is there a way we could check in to see if they actually want to do it?
You could do that. Yep.
Or just are very happy to find out that they can't. It's very possible that we're going to wreck somebody's day if we make this permissible. Again, unless
It's such a strange solution. It's
Yeah.
such a strange solution. I feel strongly if there's great interest, we should permit it. But it's a strange thing in pension world, right?
Right. So I think considering looking at our time here, maybe that would be the way to take a look at it, just kind of check in to see what they were wondering. They're wondering, gosh, we want to do this. How can we make this happen? And we can bring back kind of what we hear there, and maybe just keep it on a radar and know if this becomes popular. You know, if the kids are moving it around on their Reddit or something, you know, that could be a thing we watch for. All right. So I think if it's okay with the group, we check on the intention of the questioners and give you that next week. And any further discussion on this topic? We're going to get right in here on time. Then we're going to just go to last thing to talk about our next meeting, which is our final meeting. Okay, so our final meeting, and so Rose, if you just want to touch base on that.
Sure. So the plan for the final meeting would be to report back on this combined service pension if I hear back from those relief associations, report back on break in service and EMS only. And then the big topic will be the return to service clarifications that we've been working on, and then a final review of draft language that the group has approved.
Okay. Wow, and then we'll do the whole list, right? Fabulous. So that's again, I'll just pre-thank again for the fact that we got a lot done this year and just kind of popped it out. And again, one of the reasons this year has been easy is all the work you've done all the other years too. So I thank you for that as well. With that, is there any further business? Okay, seeing none. Well, I could say we are. Technically, I'm going to try to normalize this too. Seeing no further business, we are adjourned. Be safe. Have a great day. Enjoy the last of the heat. All right.
Thank you.
Thank you.
Bye, everybody.